2. Credit scoring and loan underwriting. Traditional credit scoring methods rely heavily on a fixed set of variables: your credit history, income, outstanding debt, and so on. But what if someone doesn't have a traditional credit history? How do lenders evaluate risk? Machine learning opens the door to alternative data: phone usage, utility payments, social behavior, even your browsing habits, to build a more complete picture of financial behavior. These models can assess thousands of data points to determine creditworthiness. They learn from past borrowers, detect subtle risk indicators, and spot opportunities to approve loans that traditional models would flag as too risky. In emerging markets, this has been revolutionary. People with little or no credit history are now gaining access to loans, thanks to algorithms that understand them better than the old systems ever could. 3. Fraud detection and prevention. Financial fraud is a constantly evolving challenge. As soon as one loophole is closed, bad actors find another. That's where machine learning really shines, especially in pattern recognition. Traditional fraud systems rely on static rules. If transaction X exceeds amount Y in location Z, flag it, but fraudsters adapt. Machine learning models evolve, learning from historical fraud cases and identifying subtle signs that something might be off. For instance, if someone in New York suddenly uses their credit card in Singapore, that might be flagged. But maybe they're on vacation. Machine learning considers context, flight bookings, past travel patterns, transaction timing, merchant reputation, and more. These models can detect fraud in real time, reducing losses and increasing trust in digital financial platforms. 4. Risk management and assessment. Risk is the foundation of finance. Every investment, every loan, every insurance policy is a balancing act between reward and risk. Machine learning helps manage this complexity with more precision than ever. For portfolio managers, machine learning models analyze correlations between assets, market sentiment, geopolitical developments, and economic indicators to assess portfolio risk. In corporate finance, ML tools assess a company's exposure to credit risk, operational risk, market volatility, and even reputational risk. Insurers are using machine learning to price risk more accurately, taking into account behavior-based data like driving patterns from GPS devices or health data from fitness trackers. 5. Customer service and personalization. If you've ever chatted with a virtual assistant on your banking app, chances are you've interacted with machine learning. Chatbots powered by natural language processing can answer queries, guide users through transactions, and even offer financial advice. But personalization goes deeper. Machine learning analyzes your spending habits, income, and saving patterns to suggest budget plans, recommend investment options, or alert you when you're overspending.